How does liquidity affect a diagonal call spread? Have you ever wondered how liquidity impacts your trading strategies, especially when it comes to diagonal call spreads? Let's break it down in a way that makes sense. A diagonal call spread involves buying a longer-term call option while simultaneously selling a shorter-term call option at a different strike price. This strategy aims to benefit from time decay on the short call while keeping upside exposure through the long call. First off, liquidity plays a major role in how well this strategy performs. When options are liquid, they typically have tighter bid-ask spreads. This means the difference between what you can buy and sell for is smaller. As a trader, this is great news because it reduces the costs of entering and exiting your positions. If you are dealing with illiquid options, you might face wider spreads, which can eat into your profits. Next, let's talk about execution. High liquidity allows you to enter your diagonal spread quickly and at your desired prices. If the options are illiquid, you might experience delays or have to accept less favorable prices. This can throw off your risk and reward profile right from the start. Adjustments are another key area where liquidity matters. Sometimes, you may need to roll your short call to a later expiration or a different strike to manage risk or lock in profits. When options are liquid, you can make these adjustments easily without having to give up too much on price. If liquidity is low, making these changes can be more challenging and might increase your risk. Now, let's consider how liquidity affects pricing. In liquid markets, option pricing tends to be more accurate and stable. This is important because the value of your diagonal call spread relies on changes in implied volatility, especially for the longer-term call. Illiquid options can have erratic pricing, which adds uncertainty to your strategy. Finally, think about your exit strategy. The profitability of your diagonal call spread often hinges on timing. You want to close your short call near expiration or sell your long call later on. High liquidity makes it easier to execute these exits at favorable prices. In contrast, low liquidity can force you to exit at less than ideal prices, which can reduce your gains. In practical terms, if you are considering a diagonal call spread, look for options with strong liquidity in both short-term and long-term expirations. This will help minimize your trading costs, allow for timely adjustments, and better align with your intended risk and reward profile. Remember, the diagonal call spread combines elements of vertical and calendar spreads, so smooth interaction between different strikes and expirations is essential for success.